Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks fall as fears over the financial sector spread to Europe, and Swiss investment bank Credit Suisse. It's lost 2 CEOs in the last 3 years, had a spying scandal, and lost billions in a hedge fund collapse. Is the current landscape the final straw for investors? And the fallout from SVB continues, with the Federal Reserve reportedly looking at tougher capital rules for mid-sized banks. Shares in First Republic not having a good day following a junk rating from S&P. This following Moody's downgrade of the wider US banking system. And of course, all this matters for the Fed, of course. Expectations for next week's rate decision fluctuate as JP Morgan sees a 25 basis point hike on the cards. Worth keeping an eye on the bond market, with 2-year yields falling amid choppy trade.
Let's talk about the implications of all of this. Jared's at the Wi-Fi Interactive for a check of the markets. First we had SVB, Credit Suisse now causing a lot of consternation in the banking world.
Yes, and to be fair here, Credit Suisse is a lot bigger than Silicon Valley Bank, about 2.5 times total assets. And let's just see what's happening in the stock futures in the U.S., and then we can check what's happening in the banking sector overnight. S&P futures down 1.86%. And if you see this chart, this is from midnight last night Eastern time, just a slow, steady decline, really accelerating during the European session. And as Julie, you were talking about just earlier, the cost to insure debt against default has just skyrocketed. Here it is, a 20-year chart, and you can see that this stock used to be, a $70, $80 stock. That was before the global financial crisis, a long time ago. Now $2.51. We're probably looking at, and we're going to talk about this a lot, we're going to talk about a potential restructuring of it, a sale. We don't know what's going to happen.
Well, expectations for a Fed policy is a mixed bag in the wake of Silicon Valley Bank's collapse and the slightly hot February CPI report. Now, JP Morgan expecting a 25 basis point rate hike, noting that strength in inflation keeps pressure on the Fed to raise rates. Morgan Stanley similarly echoing the same rate increase, citing the strong reading on services inflation. Wilmington Trust and Piper Sandler also in on that 25 basis point rate hike camp. On the other hand, though, Goldman Sachs holding to its call of the Fed not hiking rates at its next meeting.
Right now, we have been watching this situation. It's the 8th straight session that the stock has been trading lower. It has been trading at a record low as well. The Saudi National Bank said they're not going to be putting any more money into Credit Suisse after a cash infusion they had already done. How is this being reflected in the market, not just in the stock, which, as we mentioned, has been plunging, but also in the so-called credit default swaps here? What is a credit default swap? It's basically a type of insurance against default here that a company can buy. So one party purchases protection from another party against losses from the default of a borrower. Again, it's effectively insurance. You probably know a little bit more about this than I do. When a company's cut to junk, what happens then to how the bonds are priced, to the people who already hold the debt at the company?
Great question, because we haven't really talked about the ratings agencies in 15 years?
Yeah.
Well, it's been sooner than that, but you get the idea, because we haven't had to, and now we're facing a banking crisis. Ratings agencies at the forefront. They are supposed to be the gatekeepers. They're judging the credit quality of certain issuers. The issuers are companies like these banks, or it could be the Gap, for instance. And when they issue these bonds, and Moody's will reduce the credit rating on it, guess what? The interest rate on those bonds that investors require jumps up. Meanwhile, the price of the bond goes down. So those two are inversely related. So as bond prices crash, the interest rate goes up, and then separately we have credit default swaps, which are bets on that debt defaulting. And so on Credit Suisse, for instance, now I'm switching gears, but we're going to Credit Suisse, that has blown out almost to about 1,000 basis points, or 10 percentage points. When we get to those levels, those are the levels at which banks historically have failed. We're not talking about FRC failing here right now, but another definition I'd like to get to are wholesale deposits. Why is it looking for wholesale deposits? Because as a bank, it has been losing deposits, and it has to find other deposits to match its liabilities and its assets elsewhere.
Right.
So
against a company defaulting, and the price of that insurance for Credit Suisse is now basically blowing out here. Another way to measure that is to look at the different curves, the credit default swap curve, if you will, it's inverted. That means it costs more to protect against an immediate default instead of a default down the line. That's another sign of distress.
If it increases by the time they meet, they will be more tempted to zero. But also they will ask, will the financial sector turmoil and the concerns thereof make businesses more willing to lay off people, contribute to the slowing of the economy? So the financial sector turmoil will do part of the Fed's work. Now, that's not the ideal way to get the Fed's work done, but it can be part of the Fed's work.
Because as you mentioned, financials really taking a hit today. And let's take a look at our banks chart so you can see a lot of these stocks that are underwater. You've got JP Morgan Chase, Morgan Stanley that's underwater. But we want to point out Credit Suisse, as you have been mentioning, down 18% right now. And over the last 8 sessions, it has been down. I'm going to pull up a 7-day chart here. Now, investors had been concerned about Credit Suisse for some time. Also, they saw problems when it comes to the credit default swap. Those prices were spiking higher. So you heard rumblings over the last couple of days that the bank may be in trouble because that is a type of insurance on default. So when those prices go up, you know that there's trouble. So we saw today also the stock going lower. This is also after the Saudi National Bank said that it won't give the bank any more assistance. This is its top shareholder, by the way, saying no more funds for you. So this is
what do you do? Now, keep in mind, there's no tax impact unless you realize those gains or losses. So to begin with, if you have realized capital losses, meaning you've actually sold the stock at a loss, you can offset those losses against your capital gains. But again, you must sell the investment, realize the gain, and then offset the two. Now, you can offset all of your capital gains with capital losses to the extent you have that many capital losses. Now, if you have losses and you don't have gains to offset, you do have the ability to carry over those losses to future years.
We're looking at a 2-day chart here, and I pulled up the 2-day just so you could see the dramatic fall at the open. We closed well off the lows of the day, but Credit Suisse did hit a record intraday low during the trading day today, closing off just around 14%, the 2-day fall of about 15%. So some concern here after the Saudi National Bank said that, and that is the Credit Suisse's top shareholder, that they will not raise their stake in the banks. That led to some fears in the broader market. We certainly saw that reflected not only in Credit Suisse, but the European banks. Here in the U.S., a number of the larger U.S. banks are under pressure, as well as the regional banks pulling back into banking. Giant Credit Suisse rattling markets today. The problems at Credit Suisse have been mounting for several days. It started last week when the SEC made a, quote, late call to the company with questions about how the bank reported its cash flow statements from prior years.
That annual report was finally published on Tuesday. That's when the company disclosed it had found material weakness in its financial reporting over the last 2 years due to poor internal controls. The company's leadership saying they were urgently working on a remediation plan to make sure that doesn't happen again.
Well, that brings us to today. The chairman of Saudi National Bank, Credit Suisse's largest shareholder, told Bloomberg that his bank would not be investing further into Credit Suisse, citing regulations. That rattled already nervous investors who had concerns about the bank's restructuring plans. Combine that with the general unease that we certainly have seen throughout the financial sector following the collapse of Silicon Valley Bank and Signature Bank, and you certainly can see what happened. Shares closing down by about 14% today.
All of this prompted the Swiss Central Bank to issue a statement saying Credit Suisse meets the capital and liquidity requirements imposed on systematically important banks. If necessary, the Swiss National Bank will provide Credit Suisse with liquidity.
You can see that's driving some of the action after hours today, with Credit Suisse and extended trading up just about 7%. Well, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. Have a great night.